Save taxes, basics of an irrevocable life insurance dynasty trust. For U.S. persons, an irrevocable life insurance trust, ILIT, is arguably the most efficient structure for integrating tax-free investment growth, wealth transfer and asset protection. An ILIT comprises two main parts: 1, an irrevocable trust, and 2, a life insurance policy owned by the trust. An international, or offshore, ILIT is a trust governed by the law of a foreign jurisdiction that owns foreign-based life insurance. An offshore ILIT is better than a domestic ILIT because it is more flexible, and less expensive. Regarding U.S. tax laws, a properly designed international ILIT is treated virtually the same as a domestic ILIT. An ILIT becomes a dynasty trust, or GST trust, when the trust's settlor, or grantor, the person who establishes and funds the trust, applies his lifetime exemption for the generation skipping transfer tax, GSTT, to trust contributions. Once a dynasty trust is properly funded by applying the settlor's lifetime exemptions for gift, estate and GST taxes, all distributions to beneficiaries will be free of gift and estate taxes for the duration of the trust, even perpetually. The individual unified gift and estate tax exemption and the GSTT exemption are both $5 million, $10 million for a married couple, during 2011 and 2012, which are the highest amounts in decades. Under the U.S. tax code, no income or capital gains taxes are due on life insurance investment growth, and no income tax is due when policy proceeds are paid to an insurance beneficiary upon death of the insured. When a dynasty trust purchases and owns the life insurance policy and is named as the insurance beneficiary, no estate tax or generation skipping transfer taxes are due. In other words, assets can grow and be enjoyed by trust beneficiaries completely tax-free forever. Depending on how a trust is designed, a portion of trust assets can be invested in a new life insurance policy each generation to continue the cycle. Private placement life insurance, PPLI, is privately negotiated between an insurance carrier and the insurance purchaser, for example, a dynasty ILIT. Private placement life insurance is also known as variable universal life insurance. The policy funds are invested in a separately managed account, separate from the general funds of the insurance company, and may include stocks, hedge funds, and other high-growth and/or tax-inefficient investment vehicles. Offshore. Foreign, private placement life insurance has several advantages over domestic life insurance. In-kind premium payments, for example, stock shares, are allowed, whereas domestic policies require cash. There are few restrictions on policy investments, while state regulations restrict a domestic policy's investments. The minimum premium commitment of foreign policies typically is $1 million. Domestic carriers demand a minimum commitment of $5 million to $20 million. Also, offshore carriers allow policy investments to be managed by an independent investment advisor suggested by the policy owner. Finally, offshore policy costs are lower than domestic costs. An election under IRC Section 953D by a foreign insurance carrier avoids imposition of U.S. withholding tax on insurance policy income and gains. Whether domestic or offshore, PPLI must satisfy the definition of life insurance according to IRC Section 7702 to qualify for the tax benefits. Also, key investment control, IRC Section 817G, and diversification, IRC Section 851B, rules must be observed. When policy premiums are paid in over 4 or 5 years as provided in IRC Section 7702AB, the policy is a non-MEC policy from which policy loans can be made. If policy loans are not important during the term of the policy, then a single upfront premium payment into a MEC policy is preferable because of tax-free compounding. An offshore ILIT provides much greater protection of trust assets against creditors of both settlor and beneficiaries. Courts in the U.S. have no jurisdiction outside of the U.S., and enforcement of U.S. court judgments against offshore trust assets is virtually impossible. Although all offshore jurisdictions have laws against fraudulent transfers, they are more limited than in the United States. In any case, an offshore ILIT is necessary to purchase offshore life insurance because foreign life insurance companies are not allowed to market and sell policies directly to U.S. residents. An international trust, however, is a non-resident and is eligible to purchase life insurance from an offshore insurance carrier. An international ILIT may be self-settled, that is, the settlor of the trust may be a beneficiary without exposing trust assets to the settlor's creditors. In contrast, in the United States, the general rule is that self-settled trusts are not honored for asset protection purposes. In Private Letter Ruling, PLR, 200,944,002, the IRS ruled that assets in a discretionary asset protection trust were not includable in the grantor's, settlor's, gross estate even though the grantor was a beneficiary of the trust. The trustee of a discretionary trust uses his discretion in making distributions to beneficiaries consistent with trust provisions. Previously, it was questionable whether a settlor could be beneficiary of an ILIT without jeopardizing favorable tax treatment upon his death. The new ruling gives some assurance to a U.S. taxpayer who wants to be a beneficiary of a self-settled, irrevocable, discretionary asset protection trust that is not subject to estate and GST tax. As a result, the trustee can, at the trustee's discretion, withdraw principal from the PPLI or take a tax-free loan from the policy's cash value and distribute it tax-free to the settlor, as well as to other beneficiaries. In other words, a settlor need not sacrifice all enjoyment of ILIT benefits in order to achieve preferred tax treatment. An offshore ILIT is designed to qualify under IRS rules as a domestic trust during normal times and as a foreign trust in case of domestic legal threats to its assets. The offshore ILIT is formally governed by the laws of a foreign jurisdiction and has at least one resident foreign trustee there. As a domestic trust under IRS rules, the trust also has a domestic trustee who controls the trust during normal times. If a domestic legal threat arises, control of the trust shifts to the foreign trustee, outside the jurisdiction of U.S. courts, and the trust becomes a foreign trust for tax purposes. A domestic trust protector having negative, or veto powers may be appointed to provide limited control over trustee decisions. An international ILIT protects trust assets against unforeseen lawsuits, bankruptcy and divorce. The objective of PPLI is to minimize life insurance costs and to maximize investment growth. The life insurance policy acts as a wrapper around investments, so that they qualify for favorable tax treatment. Nevertheless, PPLI still provides a valuable life insurance benefit in case of an unexpected early death of the insured. Initial costs of setting up an ILIT are high, but are recouped after a few years of tax-free investment growth. Initial legal and accounting fees are typically in a range of $25,000 to $50,000. Premium loading charges are in a range of about 3% to 5% of premiums paid into offshore PPLI, compared to 8 to 10% in domestic PPLI. Annually recurring charges depend on policy value and vary widely among PPLI carriers, so careful comparison shopping is advised. For example, annual asset charges should be in a range of about 40 to 150 basis points, 0.4% to 1.5%, of the policy's cash value. The annual cost of insurance is not substantial and declines over time. Annual costs for maintaining an offshore trust are several $1,000s. Finally, investment manager fees are paid regularly out of policy funds. Cash may be contributed to the ILIT, which then purchases PPLI. If asset protection of vulnerable fixed assets in the US is a concern, then equity stripping can be used to generate cash, which is then contributed to the offshore ILIT. Of course, stocks and bonds and other assets may also be contributed to the ILIT and used for investing in PPLI. Various value freezing and valuation discounting techniques can be used to leverage the GSDT exemption.